All right. Thank you everyone for joining. I know that a lot more folks are going to be joining as we kick things off, but just we have a lot to get through today, so I want to make sure that we have the time to do so. If you don't know me already, I'm Peter. I lead partnerships for Startup CPG. If you found out about this event through another means, please check us out. We have a Slack community, almost 13,000 people strong, where you can get a lot of answers to questions like we're going to be going through today. Folks from Graphite are in that community as well. So if you have follow-up questions after this session, you can reach out to them there, reach out to them directly through their site. With that, I'm going to go ahead and pass things over to Paul. I would just ask that you guys use the Q&A feature within the Zoom webinar platform. As you have questions that come up, we're going to try to answer them as we go, but it'll help us make sure that we're keeping track of what we've answered and what we haven't yet. With that, Paul, thank you for being here. Appreciate your time, and excited to see what we're going to be going through.
Awesome. Thank you. Thanks everyone for joining. And so we have a bunch to go through. Please do use the chat. I kind of prefer that, to be honest with you, because there's kind of a lot here, and it can get kind of complicated, and there's a lot of tangents we can go on, but please do. So I want to kind of see where you guys are all at, and if I'm kind of hitting the right pieces for you guys. But again, thanks for joining. I'm the CEO of Graphite Financial. We do finance and accounting fractionally for CPG companies, as well as other companies as well. But CPG, e-com, consumer broadly, it's about 50%, a good chunk of our base. And then we have kind of other kind of VC-backed startups, SaaS, and other things as well. But we did about 4 or 5 years ago develop a really strong team specifically within CPG. There's just so much complexity that as you scale, it starts easy, and then you go into different channels, it gets very hard and quite complicated from revenue standpoint, inventory standpoint, all sorts of things, making sure you understand your metrics. So that's mainly what we're going to go through, but specifically around financial modeling. Super quick, I'll spend 2 minutes talking about Graphite, then we'll go into the actual reason you guys are joining this thing. So let me hop to the next slide. Again, quickly about us. We provide a fractional finance team as a service, everything from the bookkeeper through CFO, compressed down to the size you need. These are all different skill sets. If you have a bookkeeper or a CFO, they probably can't handle both roles. We've hired hundreds of people in these roles, and we've never met one that could do everything. And that's kind of where we come in. Significantly less expensive, less risk for the business, and we can scale with you. We've been fortunate to start with brands that like 𝐂𝐏𝐿, which some of you guys may be familiar with, that pre-launch all the way through still. So it's kind of cool to see our consumer brands grow kind of with us and work alongside them. The other thing that we do that's kind of cool, we, in addition to just basically doing the books and having that senior level oversight, we do have a business intelligence component, a dashboard. We take your Shopify, Amazon, whatever data, put it together so you really understand your metrics, the sort of metrics we're going to start going through here. And with that, we're going to go straight in. So again, this topic is probably more important than ever. The market's not, the fundraising market's not the hottest, and there's obviously been challenges in the consumer space broadly, which we'll kind of go through. We want to talk about kind of building a realistic financial model. Especially this is important if you're venture backed or looking to be venture backed, or you have other sort of outside stakeholders there. Yet keeping it simple, easier said than done, and then kind of knowing your numbers and unit economics. Again, this is one of my favorite topics to cover. This is sort of the genesis of the business. I used to be work in VC years ago. One of my first consumer-based companies was called Plated, which was in the meal delivery space. And that's really when I learned about understanding many thousands of transactions, the cohort piece, understanding the margin piece and how it all fits together, customer acquisition to understand how healthy a business is, how you could grow, how you could scale, and do so in a healthy manner. So we're going to go through some of those learnings, but a bunch more. So again, past few years in fundraising, I remember sitting down with a founder who was traveling in New York, another brand we worked with early called Brightland, and sitting down with the founder at a Starbucks in New York, and I'm like, it's kind of crazy. All I hear is fundraising, this, you know, and it kind of felt like this, and just broadly, you know, things have gone down. This is kind of, as you all know, right? We don't want to be a pessimist, but it is kind of part of understanding what's going on in the industry. This is some data from CB Insights, which I think is great. This is the overall. This is not CPG specific, but this is the overall funding environment for companies, private companies, venture funding, and it's gone down. It's, you know, not all gloom and doom. It's similar to what it was in 18, 19, right? Which are okay times, right? But certainly not what it was, you know, in 2021, early 2022. What we are seeing kind of across the board, in no matter what industry you're in, is VC and debt. The you know, one obviously with what happened with SVB and everything else, debt's tougher to get, and they're digging deeper, and so are VC funds, and they're really diving into the, you know, to the unit economics. So that's, I want to focus a lot there. On this, I have a whole section on the very specific things that I think are helpful to look at, but also we'll talk about modeling generally, and building projections. So these are two of the main things when we're setting up a financial model that we see companies kind of struggle with. One is what we call the modeler's dilemma. The modeler's dilemma is basically, and let's say you're the one building the model, right? Sometimes, especially if you're very early, you just start a company, you don't have a firm like us to help, you don't have a team member to help. So it's often the founder at the beginning. If you try to, you know, go in Excel and if you make it, you know, too complicated, it's like impossible to understand. But if you make it too simple, it really doesn't tell you anything. It's basically just punching numbers into a spreadsheet that may happen, they may not happen. You've no real root and like why you did hit plan or why you didn't hit plan. And then the founder's dilemma, and this is really important if you're VC backed or seeking to be VC backed or fundraising. Now, if you're too conservative, it's like, well, I don't know if this is kind of like a venture backable type of business. I'm sure a lot of you guys have heard that sort of thing. You know, is this a product or is this an overall brand, you know, whatever it is. And then if it's too aggressive, it makes you look sort of like naive, and not understand how things really work. And we've seen everything. You know, I've seen companies kind of go so aggressive where they, you know, like their revenue is going to be like the GDP of the United States in 3 years. Like no business has ever grown that fast in history. You know, and some are so conservative where it's like you probably will hit those numbers, but it doesn't. Is this more of a bootstrap type of thing that should grow slow and steady, or is this sort of something that could IPO one day, right, or sell for hundreds of millions of dollars? Just a couple kind of like housekeeping items on naming. You've probably heard in this red box appear all these words: budget, forecast, projections, model, pro forma, plan. It's literally all the exact same thing. I tend to just call it a model, but the main difference is, and more important if you have outside stakeholders, the budget is literally like you take the version that you're going to stick to and save it as somewhere, and that's the one you present to your board at whatever board meeting. This is what we're going for, and that's when you do a budget versus actual, which is taking your budget versus how you actually did in those periods. And that's what you're comparing against, right? So that's really the only difference, but it's the same thing. It's the same spreadsheet. You just save a version down, and you keep a working copy that you edit each month or whatever, right? And then you have like the budget, and you could always reforecast, but you don't want to do it too often. So what should this file be? So really what it comes down to is it can't have everything, right? But I really like to think of it as kind of the record of truth for everything that's happened for at least a year back, right? Depending on how, you know, old the company is, through at least a few years out. And look, the most accurate is going to be obviously what's already happened, but what you think is going to happen over the next like 12 months. That's really the most important thing. and it doesn't just have only financial data. Like it shouldn't only be what is coming out of QuickBooks and straight in. There are drivers in there, and those drivers should be rooted in reality, and be kind of how you think about the business, right? And the way I think about it is, if it's detailed enough where you could use it as like a simple instruction manual on what to do next, it's really, really powerful. If it's a thing you're whipping up just to raise money, it becomes less useful, because then you can tend to not ever look at it again, or here and there. But if it's like, this is what I need, this is what I want to do, this is what I think I need to do in terms of where I'm going to spend my money, new products I'm going to launch, what's going to look like, the discounting piece, all these factors, understanding the numbers, putting it in, it could, done right, it's basically predicting the future. That's kind of the point of it. It gets more and more hazy the further out you go, but at least the next 6-12 months, done right, you can get pretty close. I've seen some of our clients get very, very close to what they thought. Especially if you're bootstrapped, it's important, because you want to know where cash is going to be. What are the cash needs? And what is that going to look like? What's the risk on me as the founder? And VC also, right? Because the funding environment's tough, where you want to know what your runway looks like. High level, what this is not, because financial model is used for a lot of different ways. It's not a valuation model. So we've definitely seen companies that want us to take these operating models that we're building and say, okay, now, like, even if they're like pre-launch, it's like, all right, this is what we're projecting. Let's do a discounted cash flow analysis off of this, and therefore the business is worth this. That really isn't how it works at all, kind of in venture. Later stage, maybe, right? There's multiples based on things, but whether it's EBITDA margins or revenue margins, or multiples, depending on your business. But certainly not early stage. You should use it as a tool. This should really be a tool you're actually going to use. So if you start with that mentality, you'll be in good shape. And it's really like while we use Excel typically, and we're using some more software as well, but we typically use Excel for this. It really is an exercise in understanding your business. And we've always found when we sit down with companies, sure, we're building a spreadsheet for you and with you, but I think the real value comes from, it's really one of the only times you get to just take a step back and just think about every aspect of your business, start to finish. And again, it's not a cash basis. It really should, or at least it shouldn't be. It should have 3 statements: a P&L, balance sheet, and cash flow. Try to keep it moderately simple, and it should be. And then maybe the last thing I'd say here is, it's important that it should map to your accounting one for one. So every line item you have in QuickBooks or whatever tool you're using, maybe it's NetSuite if you're a little bit larger, it should be exactly the way at least the income statement is presented in your model should be exactly the same as that. So when you close a period out and you're done with that month, you could kind of very easily see how you did versus how you thought you were going to do. And let's go here. So one of the next things here is it's really important to build a model for you, and not kind of fall into the same trap as a bunch of founders that before. And I've seen everything. The founder's dilemma, again, is founders tend to put together very aggressive projections because we're natural optimists. And it tends to be because of artificial constraints or pressures that you think may exist. And it's often not the case. What is my board going to say? Is this aggressive enough of a plan to hit the A milestones that I think investors might be looking for? Really, I think the best thing to do, put a plan together you think you could do, put a plan together that is healthy, especially in this environment that's higher risk, a little bit less capital available, and use it as a tool to make real decisions. So, again, anything less is basically just numbers in a spreadsheet. So we definitely want to avoid that. And these are real quotes here that I've had from some of our clients. Like, one is, we're going crazy trying to figure out what to do. Do I need to, is my revenue going to be 9.7 this year coming up, or 10? going crazy seeing how we can get to the 10. It's like, who cares? Like it doesn't, who is it? Who am I trying to please here? Like, is it, if we think we're going to do 9.7, it's 9.7, right? And there's no point to juice it to the next level and, squeeze it further than you think you'll actually be able to do. And I've also seen, places where, founders said like, my board really wants me to push as hard as I can here to hit this, but it's not, at least I'm not the one that's going to be able to do it. I don't think this is even possible, right? So those are issues, right? It's better to address that early than kind of fall down that trap. Once you're on that treadmill, it's like impossible to get off. And again, being realistic as well. Too conservative, your lifestyle business. Too aggressive, you're out of touch. The most important thing is, I think, I'm a believer like in growing healthy businesses, and we try to work with our clients to. It's easier said than done, right? You need some investment to start things up. But if you can broadly, looking at your unit economics, which we'll go into why it's so important, as long as you could turn $1 into $3 over some horizon, you're in pretty good shape, right? Just as long as you could show that that's real and that could happen, it's okay to invest that money to do so, as long as you have confidence that it's actually going to yield, and you'll have that break-even point that's not too far out. And this is true. Like, again, I keep talking about, I just kind of seen a lot, right? I've seen this happen before, right? If you keep saying, hey, this is, and this is, again, this is your VC back, you have a board, you're not in full control of the business. You'll, and often the investors tend to be on the board, right? So you may want them to invest additionally, or right, they already have, but that you want to do a bridge round or whatever it is. You don't want to show too much weakness in the business, right? And then what happens is you'll say, I've seen this, like, oh, well, there's a one-time issue, one-time CAC issues, one-time this, one-time that. It's always, it starts looking like excuses. And I've seen CEOs not be CEOs anymore because of it. So, and this is where, we see some of our consumer companies kind of get into trouble in terms of understanding the business and how it relates to the financial stuff. Everyone, like, I'm a finance guy talking here, right? So everyone on here that understands marketing knows my first sentence is like much easier said than done. CAC by channel and doing that attribution work, that's like hazy at best, and I know very difficult. But broadly, like having a methodology, getting as close as you can, sticking with the methodology. Now, cohort lifetime value, that data is there, right? That's what's coming out of Amazon, Shopify, whatever it is you're using. So you can understand that. And then just generally, if you're able to understand that and what we'll go into it, that's extremely helpful. Understanding cash flow needs due to payback periods. That's a huge piece of it. And that's related to the first one. Not understanding the exit environment, right? So I think just generally in this market, like anything that things got hazy, right? In the past, where all startups were kind of grouped into a similar bucket at the seed and A stages. I think that's changed. And some of them are being run in a similar way, right? Where higher burn, high growth, high burn. When possible, I certainly advise not to do that, and not to raise too much, because the multiples are different, right? SaaS multiples have gone down, of course, right? Like it's not 100x revenue anymore. It may never be, but still, just understanding your business and understanding what your exit outcome looks like. If you're raising money is important. If you're bootstrapped and you do well, you'll make a lot of money on exit, right? But you don't want to get diluted. You don't want a huge preference stack in front of you if you raise too much venture. And then this is less, I've done this presentation before, and I think I put ignoring Amazon in particular and retail. That's certainly, I'm sure no one here is ignoring those things right now. So that's probably, I think, an artifact of everyone knows it's quite difficult. Shopify only, D2C only, from an economic standpoint. And again, I think a good model helps you make decisions. I'm going to skip a few of these things, but I do want to, because I have a much more meat later on in the presentation for this. The second lesson is just to keep it simple. but again, not too simple. I'll go into kind of what I mean there. The main thing is, the main thing is to start is I really believe a good model needs to start with good historical numbers. And that's really, really important. So that's one of the reasons we started Graphite. Like we were doing, I worked at a venture fund. We were doing the financial modeling work for a bunch of our portfolio companies. And we realized in order to really do a good job doing that, we also had to have really clean accounting. So you have to start with something clean that feeds really good projections. So start with good historicals. Again, easier said than done, can get complicated. And really only model out what you could actually measure in real life, data you have. Where it gets really tricky is if you're building, and I've seen this happen, if you're building a model with assumptions on things that you'll never be able to like know if that assumption's correct because you have no way of really measuring it, you can't build it that way, right? You could always, if in the future you have more data at your fingertips and you can measure things, great. But only because again, if you build up assumptions on things you could never root back to reality, they're just made up numbers, right? Even if it seems to make sense, you'll never know. If you ever misplan or beat plan, if there's even one assumption that's kind of like a made up thing that you can't go back and make sure it's right and see what happened, that can kind of throw the whole thing off. So really focus on making it information you have at your fingertips. Look, or not at your fingertips, but a simple enough analysis where you don't have to like go absolutely, all hands on deck just to put one number together. And then do a budget versus actual every single month, right? Or at least on the financial side, and then a deeper dive quarterly. I'll show you what a budget versus actual is. This is like a really simple, we got D2C revenue, Amazon, maybe retail. These are just completely made up numbers. But what this shows you is like, all right, for a given month, all right, I said I was going to do 100 D2C, that's the budget. We ended up doing 90, right? Useful information, right? Like a lot of companies don't do a budget versus actual at all, but it's like, okay, I wonder why that happened. Did we spend less on advertising? Was our kind of repeat rate from existing customers lower? Is there seasonality I wasn't really thinking about? It's all sorts of things, right? Did we spend as much on customer acquisition, but just our conversion was lower, so our CAC was higher, maybe. But it's a basis for getting there and seeing what's kind of going on. And really, in a matter of 10 minutes, you understand your business. You look at one of these, you kind of know what happened. And it's a really helpful exercise. Amazon, okay, we hit plan there, whatever. Retail, all right, what happened? Why do we have zero revenue, right? And then COGS too, understanding your margins, is obviously like, here's a case where, I showed, okay, the budget said our margin, and this is really high margin for consumer, but we said 71%, but it was actually 91%. Probably the actuals are wrong, right? So that actually this is not just an exercise in seeing how you did, but understanding is something probably maybe off in QuickBooks, right? And you could do this with all your expenses too. So important, it's definitely an important exercise.
Hey, Paul, we've got a great question if you don't mind me jumping in.
Oh yeah, go ahead.
Yeah, so a question about, what is the best way to approach forecasting when you don't actually have historicals, i.e., as a new startup? How do you, avoid putting assumptions together that are completely unfounded?
Yeah, that's hard, right? That's where I don't want to sell my own services to a company that's brand new and can't afford it yet. But honestly, I do think a lot of it is, half of it is at the beginning, it's who you're going to hire, right? So a model template, to be honest, like the one we have is put in the people you need, right? Some of the basic expenses, and that's 90% of it, right? Then it's like, how much do I think I'm going to want to spend? What's my budget, especially if you're bootstrapped or really early? What am I going to be spending in direct advertising, other things, right? And this is assuming you're like about to launch, right? And I think the easiest thing to do, you could research a little, but use someone like Peter's group here, Startup CPG, like, hey, what kind of CAC levels, just high and low, even just so like, you're not going to find anyone here whose customer acquisition cost for a consumer product that's between $50 and $100 AOV, it's not going to be $5. It's also not going to be $5,000, right? That's way too high. And you'll kind of know where maybe it's 100. You'll know around where it's going to be. And there's some resources for you, or you could work with, people experienced in the industry that can, maybe your marketing firm has some benchmarks for you as well. That's really for consumer company, that's the biggest. And then it's your margins, right? What is your product? Even if you haven't launched yet, you've done some work on the components, whether or not you're buying finished goods, right? It's that you're working with some manufacturer and you're buying a product and you're putting it together, or you're actually doing manufacturing work. Then you should have a sense as to what you put it all together, do the work. What does it cost on a per unit basis? Plus actually getting it to me to be able to sell, get all that together. That's really a lot of it, especially early on. And honestly, within months, you'll have benchmarks, and you start advertising, you start doing things. You could always tweak the thing. So hopefully that answers the questions a little bit there. Yeah, and then again, you got to dive a little deeper for kind of the e-com numbers, in particularly CAC by channel, AOV trends, margins, repeat rates. If you have that stuff, you'll be in pretty good shape. If you don't, it's tough from financial side. And then the next, it's funny actually, like literally just said this. Start with the easy stuff when you're building a model. Again, start with the template on our website. It's free, no gimmicks, right? It's not like you pick it up and 2 seconds later it's a fully built thing. But at a minimum, you could put in the people you're going to hire, your own salary, whatever it may be. And then obviously the ad spend going into that revenue build tab. Then it's your expenses, vendor by vendor, or you can do kind of broader assumptions. I prefer, I prefer vendor by vendor. For us, honestly, so I understand what's happening. But as you get larger, it's basically impossible to do that. So having kind of, budgets based on either teams or buckets, so you could like total marketing spend, total R&D, whatever, that total just G&A, rent, things like that, bucket it like that. But if you're small enough, I would do it on just your major vendors, your top handful of vendors, then everything else. And then again, the rest is the hard part, right? And we'll focus the rest of our time on that. Revenue through COGS. I've seen companies do this, and I definitely caution you from doing this, right? When I was in VC, I saw a lot of companies like, hey, I think the market size for what we're selling is, of course, it's like many, many billions of dollars. And if, and here's the market, this is how I think we're going to get into the market and the market penetration. First of all, the numbers get really big really quick, right? With really small percentages. And second, it doesn't show you're going to go from 0 to 1, like from not selling something to selling something, getting it in someone's hands. So I would advise not, to kind of do when you get to like the size of Apple, right? Then you could do that. But that's about it, not for a startup. And if you get too complex, I mean, I've seen, we take on models from companies where the model, I mean, I've seen it where we've had a contract CFO that's, not with Graphite, build a model that's so complicated, like they couldn't even really figure it out, understand where the drivers are, and it gets really, really very complicated. So try to keep it simple as you can, given these constraints. The way we build, our models up, and the way we kind of recommend, and depending on what your business is exactly, but looking at subscribers of your product, right? If your product lends itself to that, and if that's like kind of makes sense given the context, but that's one thing, because they tend to have a different characteristic than kind of regular consumers of your product. Then regular, a la carte, whatever you want to call it, right? Traditional. I order something once, maybe I'll buy it again. I'll interact again when I have a need, or when you send me some kind of promotion or whatever. And then retail and Amazon need to be kind of broken out too. And then number 3 is just know your numbers. I want to go into so I kind of want to go into some specifics, right? But really, you're going to be asked for this stuff in depth. So really walking in with confidence and being able to speak to it is really important. And there's one thing I learned as an investor. It's when a company came to us with kind of sloppy numbers, they didn't really understand their economics. It never really went well. You know, if a company spent too much time and it seemed like the founder was like only sitting there in spreadsheets to impress VCs and not like build a company, that's like the other side of the spectrum. But having a well thought out, understanding your market, understanding your product, understanding how it all flows together is really important to articulate in a fundraising meeting. And knowing the unit economics and how it relates to consumer behavior and your product is important too. I'm going to go into the specifics on that soon. So I'm sure if you've seen this movie, but also, but I've changed it in this case to always be cohorting, right? So when I was working with Plated years ago, maybe in 2013 or 14 or whatever, this was a newer concept, right? At least it was for me. Now there isn't one person on here that hasn't heard of the concept of cohorting, but I'm going to quickly go into it and explain why it's important, how I think about it, how we think about it. But if you haven't heard about it, basically the way to think about it is a cohort is a group of customers segmented with the goal of basically seeing their behavior over a period of time. And it's generally in monthly buckets. You could also do quarterly buckets, but it's more typical to see monthly buckets. Basically to see, it's basically a way to look at repeat rate and how much money you've made from that group of people over time and what that kind of retention has looked like. And I'll show you what it actually looks like. So this is an actual one that we've scrubbed. It's kind of what it looks like. So you know, the month one, this is a revenue-based cohort. You could also look at, you know, customers, right? But this is revenue. Okay, so you know, month one is 100, right? But then what did that curve look like over time? And the more months you have, the more information you have, the more accurate you could be. And then and again, this is the retention side. And the inverse is really how we look at lifetime value. Like I don't really like just throwing a number out there and saying, oh, our lifetime value is like $400, right? Our first, your AOV is $100. Our lifetime value tends to be $400. Like, all right, but over what period of time? Like, what does that mean? Are they buying the same thing over and over, different things? How does that work? So I like looking at this. Very important that this is so this is basically the cumulative gross profit, not revenue. The cumulative gross profit from a cohort you've made over time, right? And this line and that line are two different examples of what customer acquisition costs might be, just to show you examples of what it would look like. And so in this case, customer acquisition cost is, I don't know, $80, $85. And you see run month 6 or whatever, you're kind of 5, 6. That's the break-even horizon, right? That's your payback period. But for this particular company, the way the retention curve is working, because the curve is changing over time, at around a 120 customer acquisition cost, there is the limit does not exist. The cohort never breaks even. None ever do. So it's really, and it even just tens of dollars can make that difference sometimes. So it's really important to do this work. You know, not tens usually, but I mean, this is a tale of two completely different companies. And so this is, again, so you have to look at your total revenue minus all of these different things for a consumer company again, when you're stacking this stuff up. So it's not just my CAC versus revenue, because things cost money to produce and get in the hands of consumers. So it has to be everything else, the discounts, the coupons, the returns, the actual product, you know, whether you're manufacturing or you're, you know, buying kind of finished materials and putting it together, and getting the product, right? The freight to get it to the actual 3PL that's gonna send it out, the 3PL costs themselves, then the shipping, right? If you have free shipping or you know, or which I'm sure many of you do, if they go over a certain dollar amount to make it worthwhile, all that stuff has to be included, and that's how you really understand what's happening here. If you leave a lot of these things out, it's kind of a disservice. Better off kind of load everything in just so you know, and then you can go from there. Here's a tale of two retention curves. Because I want to drill down how important this is. This is just a simple analysis we did. Two companies that are very, very similar, selling things for the same amount of money. The gold or yellowish bar is one company that has a pretty, certainly it's higher, right? It's a good amount higher, but and then the blue is another company where the retention is worse, but not zero, right? It is still there. And let's see what the difference looks like. Well, if this is the customer acquisition cost here, right? This yellow bar, this is the first company, right? And this is the break-even horizon, cumulative gross profit, 24-month payback period. And that's this blue line. This is this company that I'm talking about, company one, which is blue. Now company two with the better one looks like this. Yeah, and that's like not a good place to be. That's how different and that's how profound this company is. And this is like an ultra extreme example. And like, this is probably healthier than any company I've ever seen, but still it shows the difference. And this is basically printing money, right? So you want to be closer to this, further from this. Look, consumer behavior is what it is, but again, at least understanding it, kind of what, where you should focus, right? If D2C just isn't working economically, maybe you should focus more on retail or somewhere else. I'm going to go into, looks like we got about 20 minutes left. I want to go a little bit into basic things you want to see in the model. Cash, of course, some basics about the company, really just understand just the basics about cash needs. You're losing money, you're making money, what are the payback periods? But for us, like what I love to do is, take that Shopify, Amazon data and do a couple different things. So we like to look at things a few different ways, because we could use this, you do this sort of analysis, you could use this in building the model, right? So, and these are some things I think that are important from funds and also debt providers, depending on how deep they're digging. But we like to look at kind of average order value, just trends over time, right? Or is it going up? Maybe that means you have a larger product offering. You're figuring out how to bundle things in a certain way, get people, have the consumer behave a certain way and go up. It's important to look at it though, also factoring in discounts and promotions, right? It kind of, not that doesn't count. I kind of think that's kind of like part of acquiring customers, right? So looking at it for a new customer, what does that look like? And then for repeat customers, right? How much of that is discount driven? And what is that average order value? And in both of these cases, in this example data, we had the average order value going up, little by little, right? And obviously in real life, it'll look different, right? Maybe the holidays, it's going to just spike higher than lower, but this is just like a basic, but still it kind of tells you a story, right? We have more products, it's resonating more, we're figuring it out. This is a good sign, whether you have investors or not, right? So this is important. We look at discounting and promotions, again, like how many customers do you have? How many of them had a discount? Like like really, like how much of this growth is just extreme discounting versus kind of true product market fit? I think that's what everyone's trying to figure out, right? And investors for sure understand your product's market fit and the risk associated with that. The reorder rates and everything like that, and we'll go over reorder rates, show a higher product market fit, right? We like looking at this, and again, with it's not the simplest, but with the Shopify data, you could do this. But in this case, we showed an example. Okay, people bought a customer, or 70% of customers in this example only bought once, right? And then maybe you have some subset of like super users or super customers that buy a bunch, right? But not much in between. So it's like, all right, what does that mean? That's not that great. How do we drive this up, right? So even just seeing this, you kind of like, all right, what's going on here? This is the numerical version of what I showed before, a cohort analysis. it tells a similar story. Sometimes I like looking at it like this with kind of the color, because you can see over time, we like to, it's not just, again, none of this is analysis for the sake of analysis. It's, it's in this case, like, well, what is this telling us? And it's like, okay, it looks like your early customers, maybe those early adopters, those real advocates for the brand, were better, right? They tended to reorder more, and things have kind of gone down over time. With newer customers that you acquired over the past year, whatever, after the brand's been matured for a little bit, they tend to reorder less. Like, what does that mean? If we've been acquiring customers from different places, what could we gather from this information, right? Why are things not going as well as we thought? So that's kind of an important view as well. This is another flip side of it. How many months does it take to get to that full value? If your AOV is 100, how long does it take to get to 100 again, right? How many months does it take for that same cohort to get you another $100? The shorter the better, obviously. It's just another cut at the same data. This is that CAC break even. We don't have to go over this again. And again, it has to be cumulative gross profit as well. And the other thing is just geographic. This is actually cut from our dashboard tool, but just understanding revenue by state and that distribution. And one interesting thing we've seen, I think, is a kind of a cool view, an important view, not just like obviously New York, California, Texas, like some of these larger population states, you're going to have more orders, right? Depending on what you're selling. But looking at it relative to the population in those states or geographies helps you kind of understand how, if the product's resonating with kind of a broader audience versus just kind of like the kind of the usual suspect kind of areas. And that's a cool view you could do as well, right? And obviously depends on who you're targeting, where they live and all that. But obviously something that everyone wants is better, bigger audience. And then lastly, make it easy to understand. And this is kind of the high level summary. Then we'll go into a couple questions here. One, again, build a model with you as the founder in mind, or there may be some CFOs on this call for consumer brands, but or you in mind, right? But more so than the investors, right? Do what you really think is going to happen. You'll feel better about it. You'll have less anxiety about it. Everyone falls down this trap. It's very tricky but once you kind of rip the Band-Aid off, this is what it looks like. It's going to be a healthy business. Maybe it's not going to grow as fast as we think, but this is the right way to do it. It's better to have that conversation sooner than later. It should represent what you think is going to happen. It should match your QuickBooks exactly 1-for-1, verbatim. It should be bottoms up with real assumptions, not like we're going to get a sliver of this giant market with no kind of explanation how you're going to get there. It should model what you could actually measure. And again, if the numbers are spitting things out that don't look so hot, it's crazy. Again, I've seen a lot, and I've worked with a lot of companies. I've seen companies like, well, not good enough. I guess the assumptions need to be better. I'm like, well, but we're basing the assumptions off of like what's happened, right? So we can't just like make it higher and pray that you will not hit these numbers. So probably shouldn't do that. And then again, if the numbers are good, right? And in hindsight, especially brands that were around, when things started picking up mid 2020, prior to the iOS change and everything, if only we knew that was like so short-lived, you would have raised all the money in the world or just put everything into it and just printed money when CAC levels were so low. But when things are good and they're working and they're like, oh, wow, I understand. That's when you can kind of double down. It gives you the comfort to kind of hit the gas when you understand the numbers and have a model that you could work with. Look, and that's really it. Like I see a couple questions, and this is how to get in touch. Go on our website, take a look.
Yeah, Paul, you want to just fire away? I think you can see.
Yeah, let's see. Let me pull it up.
There was a question that was in the chat that I don't want to get lost. That was, what is too often? What's the right frequency for reforecasting? How often should you guys be doing that? I think you mentioned monthly, but
yeah, no, don't refer. I mean, look, you should definitely update. Like, okay, if you have a board and if you have investors, or if you have like some major debt line that they're really looking at, they really diligenced your company. So if you have stakeholders that are like, this is the budget you told me, you kind of, that's the one, right? And then that's a saved copy of the model, right? Save it aside. That's what you're budgeting against. But update the model every month, or you can lose sight of things. Not that version of it, but have a version that you're consistently updating. And if things are tracking different enough from the original budget, then you basically have that conversation with your board or stakeholders like, hey, look, we're like totally off here. Hopefully for the better, but maybe it's worse. CAC is worse. Things are, product launches are taking longer. You know, I think we're going to reforecast is what it looks like. It's better to rip that Band-Aid off than prolong it. So maybe like, even if you have quarterly board meetings, I probably wouldn't reforecast every board meeting, but twice a year, you know, something like that.
Perfect. And then Paul, can you see the Q&A that's in there as well?
Yeah, I see. Okay, so we're pre-revenue. I know the two people I'll hire in a month and their salaries. I can assume ad spend, but it's impossible to say how much we generate in year one. Is it better to look for break even and use that as sales strength to measure? Yeah, look, and this is Simon asking the question here. If you're bootstrapped and pre-revenue, and I'm not sure the circumstance, look, and I say this to any company, right? The most important thing you could do is understand if what you have is something people want to buy. And do so as inexpensively as possible before you put too much money in and it gets me. So I think starting slow and steady makes a lot of sense, really for any company, right? And then especially if you're bootstrapped, slow and steady. Look, put it together, see what it looks like. If your first month, even if you make $5,000 in total revenue, you'll have some data like, all right, who's buying? What's it look like? What is my average order value? You'll have some of those things. You can always tweak it. But yeah, like pre-launch, it's hard to say. I've seen companies really skyrocket their first year, but also most are a slower ramp. So the next question here, what are some key KPI benchmark levels for emerging versus stable CPG? Gross margin, D2C and wholesale, marketing percentage of revenue. Yeah, look, so let me start with staffing. And I wish I had because it does vary. What I've seen broadly is keep your G&A level pretty lean. Until, again, once you're growing, you know a lot of information. You know what's happening in your business. Keep things pretty lean. I really believe that. So from a staffing standpoint, that's money you're paying no matter what, right? Again, you need folks to help you, but really thinking about, so any new person, incremental person you bring in, again, this is CPG, SaaS, any company, especially if you're smaller, you're not super well capitalized yet. Is this a full-time job? Is this something I could probably outsource to start? Could I use a consultant to start, right? Those are things I probably think about. Look, margins, I would say, look, for D2C, the gold standard really is if you could be first order profitable, taking customer acquisition cost minus revenue that you brought in, but then minus all your COGS associated with it, right? Your cost of goods, getting it in the hands. If you could be first order profitable, not just break even, you're in really good shape. So it depends so much. Again, this is the anonymous question that came in, but it really depends, right? And I'd say but for D2C, I'd say the higher AOV, the higher chance you have, because like CAC's not going to be $5 for you or 10 or 15. It's gonna be higher than that, like a good amount higher, and maybe your margins are somewhere between, I don't know, 35 and 60 something percent, right? So you got to just do the math, see where your kind of your product is at, and it varies. Sometimes you just get lucky and you have a product that's like really high margin, and you could sell it for a lot because of how you're branding it, and it's something people want. It's novel, you know, and so it does depend. Okay, hopefully that answered that one. In our industry, working capital is obviously a big piece of it, especially for retail. How do you usually approach that piece of the model without making it overly simple or complex, right? So there's different products and services out there, right? That I'm sure many of you guys have. I'm not gonna like say the names. Because I don't want to like on a live thing compare and contrast like different debt providers for CPG companies, right? But I think like, look, I think that probably some of the easiest money to borrow is like for retail, right? It's like I have a signed PO from this large retailer, right? And these are the margins, and look, they're gonna take a while to pay, but I have the PO, and I have to spend a bunch of money on inventory. You know, so that's different than sort of like, you know, I just need general working capital to like float the D2C side of the business. So again, it's company by company, and it really, a lot of it depends on the, you know, actual retailer you're working with and kind of what the payment looks like there and the lead times, your kind of payment structure with your suppliers. Hopefully that's helpful. I'm being pretty broad, but okay. Next one says, if I don't need to pay myself for a while, what would be my budget per year? Assuming minimal growth, high expenses. I'm still at the initial stages. My friends and family were going to invest seed capital. What kind of investment strategy should I follow? Be in the frozen category. Yeah, I mean, look, so if this is, you know, if you don't need to pay yourself, the one thing I'd say is like, I probably avoid that. And I'll just say that there isn't a lot of glory in look, if you've, you know, made a bunch of money in the past, it's a completely different thing, right? But like, it could really add to your stress levels. So if you're raising, look, it's tough. If you're raising from your just like your parents or something, and then paying yourself, going and just turning that into salary for you, that maybe that's weird, and you shouldn't really do that. You know, especially if it's not a lot of money. But if you're even raising from angels or kind of micro VCs, I think it's fair to get yourself a little bit of a salary at least, just to get going, even like health benefits and things like that. It takes a lot of stress off of founders personally. I've never seen that kind of go well. It starts okay, but if it goes on too long, I've seen a lot of not a lot, this happens only sometimes, but I've seen our founders get like in a pretty anxiety-ridden, hard, tough place, like when they're not paying themselves for a prolonged period. So I say that again, that's fine. But you know, maybe it depends on your product, but maybe it's hundreds of thousands. It's not millions, right? You can certainly launch a brand without millions of dollars, right? It's a general feedback there. How do you think about allocating organic social media costs and CAC? Yeah, so let me say that a little bit more clear. So how do you think about allocating organic social media costs in CAC? It's really hard. So I mean, if you guys are working with some kind of agency on the marketing side, or you're doing it in-house, like I'll give you a story. It's not a consumer goods company, but it was a consumer software company we're working with, and CAC was pretty good. It was like $30, right? But blended. They didn't have a good enough way to really measure kind of their customer acquisition cost, right? Or attributing it to something. So $40, and they're, you know, let's say they're profitable day one off that sale. It's like, all right, why don't you, if you're spending 50 grand a month, and this was real, you're spending 50 grand a month to make you know, $100,000 a month in revenue. If you spend 100 grand a month in marketing, right? Maybe it shouldn't that double, right? It should be 200. Next thing you know, the company doubles their marketing budget, revenue stays the same. Okay. They double it again, or maybe not double again, but went up by like 50 grand again for the month. Revenue stayed the same. Then they're like, eventually the founder is like, am I going crazy here? Turn kind of direct advertising almost off, down to like 10,000 or 20,000. Revenue is like almost the same. And basically what they found there is like, they didn't realize is so much of their customer acquisition was coming from organic means through different blogs and actually affiliates in this case. And a lot of the paid stuff wasn't really working, and they didn't have a good mechanism to track it. If you could track it, like if anyone could crack that code and do it reliably, you know, a lot of companies are in this space. But yeah, it's tough. It's really tough to understand. You know, people flipping between devices, and maybe they come back, they tell someone else, their spouse, about it, and then they buy the product. It's really hard to do the attribution stuff, but you know, at least have the data you can, look at it, you know, across everything, look at it for the ones you would certainly attribute to paid, and that's the way I'd kind of look at it to start. Should we build, next question, should we build a model, multiple models that capture multiple scenarios? Yes. So one thing I didn't say, and usually we'll try to do this in one model, is build scenario planning. And where it gets tricky is, it's like, what is the assumption that is different that makes it worse, right? So for example, we've seen companies say, you know, we have a best case scenario, a mid case, and then a bear case scenario. But what are the assumptions that are different? So just like making sure it's not like everything a little bit, so you understand why. So maybe it's like, well, I'm going to hire less people. Okay, here's a plan. We're doing all the same stuff, but we're just going to it's going to be a little bit tighter. The team's going to be really busy. Another could be, well, we're going to hire all the same people, but maybe we're going to spend less or more or less on sales and marketing, but customer acquisition, we're assuming the same. The other could be neither of those, right? Everything's the same, but actually retention, we think, is going to be better because we're coming out with new things, or we're like pushing consumers to subscription. Like when they check out, it's like, do you want to subscribe and save and whatever, and you convert them there. We think that'll be better. Yeah, so it depends on what it is, but certainly do, you know, as you're building it, I would definitely play with assumptions. But then again, it gets complicated if you have like 5 different versions of the model and you like forget which one said what. So the answer is yes, just like try to keep it pretty simple and remember like what the differences are, but ultimately stick to one that you're trying to go for, so you have kind of a North Star. Next question is there a resource for startup food CPG launching Shopify e-com for average, reasonable ranges for CAC, AOV? Yeah, it really depends. AOV is really going to be a function of what you're selling, right? So if you're selling, I'll tell you where you're gonna, what's very hard is if you're selling an inexpensive product that's like decent margin, it just gets like, you know, you saw the thing from like the Christmas Carol, Mickey's Christmas Carol, where he's like slicing the pea that I had before, that animation I had. It's very easy for that to become like zero really easily, where if you're selling a more luxury or premium product or a larger purchase type of thing, AOV is going to be higher, but it all plays together, right? Maybe you sell a one-time, I sell expensive, some single good, I'm looking at my backyard right now, a backyard fireplace that's $1,000. Okay, but I'm going to buy one of those, right? But certainly my customer acquisition costs, it's not going to scale linearly. I'm going to make money off that first order. Definitely, I'm going to make money off that first order. But if it's like I'm selling something for $10, yeah, it's tough, right? So it depends on what it is. But maybe that $10's not going to work. But let's say it's a $30 thing, right? But it is like, it's a consumable product that lends itself to subscription. Maybe that does work. And what does the payback period look like then? But again, generally, the closer to first order profitable you could be, the better. ROAS, that's an interesting one, because I didn't say that once here. I said LTV a couple times, but to me, the visuals tell you a lot more than like whatever either of those numbers are, right? So if you said to me, oh, my LTV is 400 or my ROAS is that, what does that really mean, right? If you're getting ROAS from your, and if you're working with a marketing agency, just like if they're giving you kind of the ROAS from what they're doing, make sure though it's not like, it's based on the full cost, and not looking at it on not looking at top line revenue as the benchmark. Like really, it's the full fully loaded, the actual gross profit you're making from the thing, right? And then you could factor in whatever kind of reorder rate there. Okay, next, any best practices and examples for inventory building in a financial model when you prepay for a product a few months in advance from when you receive the product in your warehouse? Yeah, so the way we typically do this is we look at what your projected revenue is going to be if however many months out that makes sense, know what the margins are, therefore knows what the inventory. So it's basically saying, okay, based on what my sales are going to be however many months out, now we're in May. It's like, what do I think I'm going to be doing? It's crazy before you know what you guys are going to be buying for kind of the holiday season. That's how early, but like September, October, what do I think I'm going to do? Therefore, what do I need? And that'll make the cash flow out of the model, right? For modeling purposes. And then again, when you sell the good, it'll account for that, right? In COGS, and it's not double counting. So it's a balance. So again, that would be on the balance sheet in the financial model template. Next question. What would you say is a good standard for unit margins for a new consumer product startup? Yeah, again, look, let's assume your customer acquisition cost is going to be like, I'm just saying a number, like between $60 and $100, right? Or something like that. It depends on how much the product costs, right? But certainly if your product margin is only like 20%, like it's going to be really hard to make that work, right? So you gotta, and it's better to know that before you kind of go into it. And you're like, look, maybe you can improve margins over time, right? But like as a startup, like don't count on that day one. It's like, how are we going to be in business next year, the year after, or the year after, right? Okay, if things are going great, yeah, in 20 years, you'll have, or 10 or 20 years, you'll have plenty of power and half behind you to get margins better. But really, really think about what those margins are going to look for you in the short and medium term. And what could you sell the product for? And if it's not there, and if you're like, this doesn't lend itself to repeat purchase, it's a one-time purchase, and the margins are going to be like 20%. And I don't think I could sell this thing for $200. I think it's like an $80, then maybe it won't work, right? So it just depends on kind of what it is. So think about it in the context of not just, and look, if I had to say a number, I don't want to be wishy-washy, 50%, right? Or that better, right? That's good, right? Anything lower than that, 15, 20, 30, it gets really hard for any company to survive on margins like that. How do you recommend developing a financial model for a new CPG company that is bootstrapped? All acquisition is through organic and the founder's time. Should the model be based on revenue generated from projected customers through marketing efforts? I would just like, it's based on what you're going to do, right? If it's bootstrapped and you're using your kind of social media presence or other efforts, maybe affiliates or whatever it is, that's how I base it, right? If that's kind of what the plan is, it's like, this is how many people I think I could reach. This is how many people I think can get to the website. This is what I think the conversion rate is going to be. Again, these things are kind of built into the, the template, but that's kind of how I think about it. Just how you want to run the business, see what it says, right? And if you're like, oh, wow, you know what? Like, I don't think we're going to sell enough for this to be lucrative. Actually, only doing it that way, we probably do have to sell on, do some kind of paid stuff as much as you don't want to. And as much as like, for many, you saw there was like a Facebook issue 2 weeks ago where I think there's sending credits out now. As long as you don't want to have that risk, maybe it is what it is, right? So I think about it, again, it's what you're going to do. And again, bootstrapped is you own the thing, right? So you could do it however you want and see what the numbers say and go from there. Then if it says, if you don't have D2C, how have you seen companies look at customer acquisition cost, lifetime value? Yeah, look, I think like for retail, a lot of it depends on what that rollout's going to look like, what the contract is. And, it could, what I'd say there is it's, if let's say you're doing retail stuff, you've probably got a team out there. It gets tricky, right? We worked with some companies in food and beverage that are, look, maybe they like you can sell it online, but it's like it doesn't really lend itself that well to do it. It's really got to be in retail stores, and that's where their consumers are, and that's where they're going to be buying the products. So that's where they're going to be seeing it. Maybe you start early on. It's you trying to open those networks up and get in these stores, but maybe you've got a team. It's not the cheapest, right? You've got folks on the ground going all around trying to get this distribution, these partnerships and these distribution channels going. That's a lot trickier. That's almost like looking at customer acquisition costs for like an enterprise SaaS company, right? Where you kind of have to attribute a piece of the people doing the work, generating the revenue as the customer acquisition cost. And it's very tricky because it's like, all right, and what does the rollout look like? Is this like just a pilot program? It's quite a bit harder. And LTV is like, could be ridiculously amazing, right? If like things go well and just, okay, nationally, we're rolling you out, but it's much harder to look at that way. So I'd really like, and usually that's like, you're looking at a couple of deals or retailers that are driving quite a bit of the revenue. So that's almost like contract by contract, what the margins kind of look like and everything. And then the last one, anything to look out for when modeling for a consumer product that's a luxury good, where it's a one-time purchase. Yeah, then absolutely making sure you've got to be first order, not just first order profitable, right? Like if you're selling a product and it's $200 or something, right? And your customer acquisition cost is like 90 and your margins are 50. You don't want to be making only like $10, right? Like after all said and done, because those are the $10 that are chipping away at like all the salary. Like that's before paying anyone, right? That's just you got to think about it like how many apples do you need to sell, right? To like be able to now cover all the people that work here, right? And to think about it in that context. So if it's definitely a one-time purchase, like it's got to be pretty high. It's got to be pretty high when make sure you're making enough money and you're comfortable with the volume you'll need to actually do to make it all make sense. Yeah. Peter, awesome. I think we did all of them.
Paul, that was great work. I appreciate you staying a couple minutes over.
Yeah, no worries.
Yeah, and thank you. I mean, we've still got almost 50 people on the line, so appreciate everyone who stayed engaged through the end. And I know this is an incredibly valuable session. So recording will be posted on the Startup CPG Vimeo page. Everyone who's registered for this is also going to get a note, I think Friday of this week, with the recording, as well as some follow-ups from Graphite. Couple things to plug real quick. Paul gave the Startup CPG Slack a plug earlier. A lot of these questions, if you're looking for benchmarks, other brands experience, reach out to folks via the Startup CPG Slack. Throw a post in the e-commerce channel, throw a post in the sales channel, marketing channel. A lot of folks there that have benchmarks that work in similar spaces, I'm sure, that can help out. And then, Graphite also has office hours with Startup CPG. There's, I think, 5 or 6 spots every month that are available. So we post those in the finance channel. Keep an eye out for those. They fill up really quickly, but it's a great chance to get, 20, 30 minutes with the team to cover a little bit more in depth on some of these questions that might be applicable to your specific business. So clearly a lot of questions, a lot of interest, and a lot of great stuff that we learned today. So I appreciate it, Paul.
Thank you. Thanks, everyone.
Thanks.
All right. Bye.